a company earning about 6% on the capital it employs, priced at 155 times trailing earnings. That is advanced micro devices today, worth some $782 billion on a bet that it becomes a dominant force in artificial intelligence chips. It holds single-digit share of a market NVIDIA controls with roughly 7 parts in 8. The question hanging over every share is simple. Is this re-rating built on contracted, durable demand or on expectation that has repeatedly outrun the fundamentals? By the end, you will know what AMD's data center surge is really worth, where its profits come from, why its returns on capital look thin, and whether a fair value estimate can justify a price near $476. AMD designs the processors behind modern computing. Ryzen and EPYC central processors, Radeon and Instinct accelerators, the adaptive chips from its $49 billion Xilinx purchase, and the custom silicon inside game consoles. It designs, Taiwan Semiconductor builds. That fabless model keeps capital spending light. 3 reporting lines split $34.6 billion in fiscal 2025 sales. Data center leads at $16.6 billion, nearly half the company. Client and gaming adds $14.6 billion. Embedded, the Xilinx franchise, contributes $3.5 billion. Data center is both crown jewel and single point of failure. Its fate is decided in a few procurement meetings at Microsoft, Meta, Amazon, and Anthropic. First quarter 2026 data center revenue hit $5.8 billion, up 57%. The inflection is real, and so is the dependence. The top line tells a story of real expansion, unevenly delivered. Sales grew from $16.4 billion in 2021 to $34.6 billion in 2025, then $37.5 billion trailing. But revenue actually fell in 2023 before the AI cycle drove a 34% surge. Earnings tell a far less flattering story. Diluted earnings per share were $2.57 in 2021. 5 years later, $2.65. Essentially flat, while revenue more than doubled. Per share profit went nowhere for years, the fact most likely to surprise a casual observer. 2 forces explain the disconnect. The Xilinx deal was struck almost entirely in stock, lifting the diluted share count from 1.23 billion in 2021 to about 1.64 billion today. A 33% jump that spread earnings across a far wider base. The margin trajectory is the encouraging half. Gross margin bottomed at 44.9% in 2022 and has climbed to 50.3%. With management guiding toward 56. Operating margin recovered from 1.8% in 2023 to 11.7% trailing. Return on capital meets the hardest evidence here. Before Xilinx, AMD earned 37% on invested capital. The acquisition ballooned the base past $60 billion, and returns collapsed under 1%, clawing back to just 6.2% trailing, below any reasonable cost of capital. The balance sheet removes any solvency worry. AMD holds $12.3 billion in cash and investments against $3.9 billion of debt, a net cash position. This is a company that could fund its ambitions without touching credit markets. Cash flow quality is the most reassuring number in the file. Trailing operating cash flow is $9.7 billion against $5 billion of net income. Free cash flow is $8.6 billion after just $1.2 billion of capital spending. The fabless model converts profit to cash. Where the cash goes reveals priorities plainly. Real reinvestment runs through research and development, $8.8 billion annualized, dwarfing capital spending more than 7 to 1. That is the right place for a chip designer to spend, and it is the engine of the data center inflection. Buybacks are defensive, not accretive. AMD repurchased $1.3 billion of stock in fiscal 2025, yet the share count still rose because stock compensation of $1.76 billion a year outweighs it. The buyback runs to stand still, and there is no meaningful dividend. The defining allocation event remains Xilinx. The strategic logic is sound. But 4 years on, the numbers do not yet vindicate the price. It multiplied the capital base roughly tenfold, while returns sit near 6%. Superb reinvestment, undercut by an acquisition still to earn its keep. Still ahead, whether that price can be justified, and the single risk that could break the thesis. The moat is real, but narrow. In x86 processors, AMD is one of 2 players on Earth, a duopoly with Intel that has taken server share for years with EPYC. But the segment the market is paying for is where the moat is thinnest. AMD holds roughly 6.7% of data center AI chip revenue against NVIDIA's 87%. NVIDIA's edge is not silicon, it is CUDA, the software a generation of developers already knows. Pricing power is what a moat produces, and AMD lacks it in graphics. Its operating margin near 12% is a fraction of the 60-plus NVIDIA commands. Returns that swung from 37% to under 1 and back to 6 mark a business exposed to cycles. The macro backdrop is actively hostile here. The Federal Reserve has held its policy rate near 3.5% and leans toward hikes, not cuts. For a stock at 155 times earnings with a beta of 2.47, higher for longer rates punish distant cash flows. The semiconductor sector sits in the expansion phase of an AI spending supercycle. Hyperscaler budgets keep ratcheting up, with Amazon's spend expanding toward $220 billion. That capital fuels AMD's ramp, but cyclical peaks are exactly where the bubble debate grows loudest. The stock's positioning captures the ambivalence. After a roughly 170% run this year, shares sit near $476, 18% below the 580 high, in the upper middle of a range that bottomed near 151. Sentiment has cooled ahead of the real catalyst, second quarter earnings on August 4th. The market will test whether the MI350 ramp, with MI400 pulled forward to 2027, is turning marquee partnerships into reported numbers. That print and continued hyperscaler commitments are the genuine catalysts. So what is it worth? A discounted cash flow base case, 22% revenue growth for 5 years, and free cash margins toward 25%, lands near $130 a share. A bullish case reaches about $225. Call the range 160 to 250. Wall Street's numbers are aggressive. Consensus revenue runs $50.1 billion for 2026, $79.4 for 2027, and $107 billion for 2028. Growth of 47, 58, then 35%. Earnings per share climb to $7.50, then $13.79. Fair value asks for less. A sales multiple flatters this story most. Trailing enterprise value to sales of 21 times is extreme, but forward it eases to about 15 times 2026 sales. A fair 10 to 12 times multiple supports roughly $305 to $365. Generous, since it rewards growth without demanding profit. Blend the 3 lenses, cash flow and earnings weighted most, sales least, and fair value lands near $250 to $370, centered around $305. At $476, the stock sits about 29% above the top of that range. The largest risk mirrors the whole thesis. If hyperscalers keep AMD as a token second source, data center growth decelerates below the mid-40s guidance. Watch the sequential data center growth rate. A guide to flat to single digits signals the ramp is topping, and at 63 times forward earnings, there is no cushion. A quieter risk is the inventory build. At $8 billion and 158 days, inventory runs ahead of shipments before the MI350 and MI400 ramps. If demand disappoints, that becomes write-downs. Watch gross margin. A break below the high 40s signals pricing and inventory pain. The upside is equally concrete. Should the MI400 capture 15 to 20% of a $200 billion accelerator market, the street's forecasts prove conservative, and today's price looks reasonable. AMD has out-executed low expectations before, but it must happen faster than the base case allows. On the evidence, AMD looks expensive. The business is genuinely improving, revenue past 45% growth, expanding margins, net cash, strong free cash flow. But the price capitalizes a decade of near-perfect execution, while a 6% return on invested capital still trails its cost of capital. This is an educational analysis, not investment advice. Nothing here is a recommendation to buy or sell any security. Do your own research and consider your own circumstances before making any decision. If this breakdown helped, subscribe for more equity deep dives and tell us in the comments which stock we should analyze next. Your suggestions genuinely shape the queue. Thank you very much for watching, and we'll see you next time.